Well, good morning. Megan stayed at her homestead this morning, so she's making me jealous sitting outside again. But we have a lot to talk about. What is happening in the real estate market? What is happening with the Fed? There is a ton of economic reports that came out this week. Unemployment came out last Friday. Things are shifting on a weekly basis. It's not even monthly anymore. This market is also, you've got two reports that contradict one another. So how do you make heads or tails of it for your clients? Well, we're going to be sharing what we know. Megan's going to be going knee deep into the real estate data. I'm going to start talking about the economics, and we're going to share everything that will help you inform your buyers and sellers this weekend. And as you know, Megan Aller, myself, Nicole Ruth, we're here to support you. If you're working this weekend, I know I am. Title doesn't need to. Lenders do need to. But we're here to support your clients and would love to do so. So here's our quote as we kick off, and then Megan will take over. The secret to getting ahead today is to focus your energy not on fixing and fighting the old, but on building and growing something new. Reset and step forward. There's nothing about your present circumstances that prevents you from making progress, one tiny step at a time. I'm hearing a lot of people that are getting stuck, right? It's like, how do I do this? Business looks different than it did the last 2 years. As you know, as agents, you have to work a listing differently. You have to work with buyers and communicate differently. As lenders, we have to approach it differently. The market is getting chippy and competitive, and it's scary. So how do you take tomorrow? You don't take it like you did yesterday. Each new day is new. Each new challenge is accepted. And this is how we continue to grow, not by lamenting on what was, but by getting excited about what will be. So tons of opportunities. In changes comes opportunities. Miss Megan, what is new in our real estate numbers?
Well, I went through and I pulled all of the monthly numbers and the weekly numbers for you guys in this last week. So I wanted to go over some of the information that we were talking about with multiple offers and how much those have calmed down since just the last 2 months. I also wanted to go over the weekly numbers with you because we're starting to see more drag in our marketplace where homes are taking longer to sell in the marketplace. And it's not going under contract in the first weekend and people are freaking out. I told you a couple of weeks ago, I had to talk a seller off the ledge that had a $2 million listing in Wash Park that wasn't under contract in 4 days, and they were freaking out. And right now, average days on market are really starting to stretch out, especially at those higher priced homes. And so we've got to put a lot more effort into staging those listings, getting great marketing materials out. I see a lot of people returning to doing mailers and just listed cards in order to get the word out that they have a new listing in their market. It also works as a great opportunity for proof of production, which your title company, First American, can help you with. And so please reach out to me as you get new listings, and we've got listing care packages that I can send off to you so that you guys have that nice staged, ready to go listing so that people are ready to look at that home and it's show ready. And so the key here is getting every home to have as much curb appeal as possible, because those homes with lime green walls, awkward floor plans, or sitting on busy streets are starting to get passed over at this point. And so you've got to make your home as beautiful as possible so that it's ready to go under contract. There's still a fair amount of homes that are going under contract in the first weekend, but I've started to hear from people that they've got listings that they put up in weekend number 1, they had a fair amount of showings, but then weekend number 2, suddenly they're going under contract with multiple offers. And it's not like the 5 to 20 multiple offers that we were seeing back earlier this year, but they're getting 2 or 3 good offers on the second weekend. And so again, a lot of people are waiting for that feeding frenzy to die down over the first weekend, and they're going under contract in the second weekend. 2 weeks on market is still historically not a lot of time, when average days on market over the last 15 years is closer to about 40. And so again, it's still a very fast market, but it's not the market that we experienced back in January and February. And so to go ahead and talk about that point a little bit more, I pulled up my multiple offer analysis from my monthly report so that I can share this with you guys.
Oh, you went on mute.
I went on mute. And so trying to get into my slideshow now so that I can show this to you guys, multiple offer analysis. And so the way that I look at this is that I compare the last asking price to the closed price. And if it goes for even $1 over its last asking price, I consider that to be multiple offers. Now, there aren't a lot of deals that are going for just $1 over asking price. A lot more of them are going for $25,000 to $40,000 over asking price, but there's a lot fewer of these multiple offers that are happening right now. And based off of data from last month, looking at multiple offers, our multiple offers are in red, full price is in green, and under asking is in blue. over asking was only 20.6% of our closed transactions for the month of June. And so that's more closely correlated to listings that went under contract in May, but the rate of multiple offers has dropped off significantly. And so if you've had one of those buyers that dropped out earlier in the year because it was just too competitive and they couldn't make up an appraisal gap, they weren't willing to waive inspection, or perhaps they were a contingent transaction, loop them back in now because they're much, much less likely to be in these multiple offer situations. Multiple offers month over month is down 52.9% from just the previous month. And so multiple offers have really, really started to subside. When we look at it broken
Hey,
out
Megan,
by close, yep.
I really want, can you go back to that slide?
Mm-hmm.
You're not right here. I can't bug you. I can't look at you and you know I want to talk. I just want to point out, because everybody keeps talking about how this bubble is going to burst. What is the recession going to do to housing? There's a lot of fear. And of course, there was a ton of headlines about the CPI, which we'll talk about in the back half. But I really do want to highlight Megan's slide here. Yes, if you compare it to next year, it's off, but look at it compared to 2019, 18, 17. I mean, it looks like, and Megan, correct me if I'm wrong, but it looks like we're going back. I don't want to say back towards normal, but back towards what you would expect for this time of year.
Yes, I would completely agree with that. This year is a lot like 2019. In 2019, you saw interest rates go from 3% up to, it was 4.5%. And there was a big change in affordability that happened at that point as well. But we adjusted to the new rates. Rates went back down again and people started buying homes again. And so again, what we're starting to see is just this less competitive marketplace that's great for buyers to circle back around in and have a chance at ownership. Again, if you're paying rent, you're paying 100% interest every month rather than paying 6% or 5.5% like what the 30-year fixed rate is right now. And so again, it's still a great time to get into the market as a homeowner, and it's certainly not the top of the market. We're still expecting appreciation to be very strong going into next year, and having a challenging time as we go through January through June of next year, returning to more of a seasonal cyclical cycle in our marketplace. Looking at multiple offers broken out by price range, again, $400,000 to $500,000, $400,000 to $600,000, was only 15.1% of them went for over asking price. And we're looking at closer to 20 to 30% over asking price for homes all the way up to $3 million. $3 to $4 million, we saw 6.3% of them selling for over asking price. For the 4 homes that sold between 4 to 5 million, it was half of them, and over 5 million, it was about a third of them sold for over asking price. But we've seen the rate of multiple offers slow drastically from the 70% that we were seeing in the month before down to about 20 to 25% now in our market currently. Now, where you're most likely,
Megan, does this account for, Teresa asked the question, it's a great question. Does this account for multiple offers where one is under asking and then you get a second one that is over asking? Because she's asking based on how the multiple offers is assumed.
So the multiple offers is assumed by, I look at the closed price versus the last asking price. And if it sells for even $1 over the last asking price, then I consider it to be a multiple offer. Now, again, there aren't a lot of homes that are selling for just $1 over asking price. More of them are selling for $20,000 to $40,000 over asking price. But that's how I'm looking at it. So if the property sat on the market for 3 weeks and then a price reduction was made, and then it goes for multiple offers, I still count that as a multiple offer because it was it was sold for more than the last asking price. So I'm not comparing the original price, I'm comparing the last asking price to the closed price.
So if one person thinks that there's going to be multiple offers and goes in over asking and there's no other offers, that would still look like it was a multiple offer because it went over asking.
Look like it was multiple offers.
Yeah.
Yep, I have no way to actually gauge how many offers were put onto a property. I can only gauge if it went for over asking price or not.
Right.
Yes. So looking at where we are for multiple offers, we were looking at about 81.3% up here, between 70 and 80% as we get along that eastern edge of I-25 and Old Northland and Thornton. The eastern edge of Denver, the western edge of Aurora continues to be very hot with about 75 to 80% odds of selling, going for over asking price. Down here into the Littleton corridor, we're looking at about 75% selling for over asking price. And we're seeing a cooling trend that has settled into the south and the east portion of town, getting into Parker, Castle Rock, and Elbert counties, and as well as out here into Bennett, where we're only seeing about 40% of those homes selling for over their asking price. Looking at how far over asking price you have to go, down here in the $400 to $1 million range, we're looking at about 4.5% to 6% over asking price, whereas back in January and February, it was about 10% over asking price. We're still seeing significant multiple offers for those 20% that are selling for over asking price that are over $1 million. We're seeing somewhere between 8 to 10% over asking price as we get into higher priced homes that are going for over asking price. So again, the rate of multiple offers has slowed drastically, but the amount over asking price for those 20% that are selling for over asking price has come way down. Where we're seeing the most significant offers over asking prices on the west side of I-25. As you get out here into the foothills communities, we're looking at anywhere between 6 to 9% over asking price. Applewood continues to be a hot spot at 8.3%. Inglewood continues to be a hot spot at 9.1% over asking price. And as you get out here into the south and east part of town, you're looking at 3 to 5% over asking price, as it is as you get up into the Brighton corridor, where it's 3 to 6% over asking price. So again, the multiple offers have really slowed down in terms of how fast and furious this market is getting. And so that's great information for your buyers that you want to circle back in that maybe popped out of the market early this year to get them back into the market, because prices have started to stabilize and we're not seeing the same rate of price appreciation month over month as we had been seeing previously. Let's go ahead and hop into the weekly numbers now. And so we'll get into those and we can talk a little bit more about price reductions. Oops. Just a sec, I got myself all screwed up here. Hold on just a sec. Close that one down.
As long as you don't ask me to tell a joke, we're good.
I know. No, I won't do that. I won't do that to you this time. And so we'll get into the weekly numbers now so that you can see how things have shifted and changed this week. Give me a second to get into the slideshow. And so I've got my little pop-up windows right where I need to go in to get into my slideshow. And so I've got to wait for that little spot to disappear before I can actually start the slideshow. And so looking at, this is for July 6th through the 12th. And so typically over 4th of July weekend, we see between a 30 to a 40% reduction in the amount of showings that go under contract over those particular weekends. And then the weekend following that, we end up seeing a slight rebound in the marketplace. We did see a slight rebound. Showings did go up this last week. And I don't know why this isn't disappearing. And I can't get into it because it's the mute button. So I'll just go ahead and slide through this like this, and we'll hope that that disappears and I'll hop into it. But this looks at our heat map for where we are in terms of our cooling trend. And you can see that the cells started to turn a little bit yellow, indicating that it was a little bit warmer market this last weekend. As we started to go through just after July 4th weekend, we had a little pop of activity where some more homes went under contract and showings started to increase. And so that's some good welcome news for people that were waiting to put their listings up on the market. Looking at our information about predicted month supply of inventory, we're still sitting at 1.1. It popped down from the 1.3 that we saw this last week. There were a lot fewer new listings that made their way to market. Over Independence Day weekend, the rate of new listings coming to market ended up declining by about 50% over that particular weekend. So new listings and coming soons popped back up pretty drastically, where they increased week over week by about 76%. We're putting up about 1,500 new listings each week, and only about 2/3 of those are going under contract each first weekend. And so we're starting to see this buildup of inventory where our average daily active count is now up to about 5,500. That's still down from week over week by about 0.3%, but versus where we were 1 year ago, that's up 44.3% from where we were 1 year ago. So even if you had those buyers that were looking 1 year ago that got bought out of the market, now is a great time to circle back to those folks. Pending transactions jumped up by about 23.6%. And so we're putting about 1,200 units under contract each week going forward into the summer months. Now, if you have a listing that you've been holding on to and you're trying to decide, do I want to list now or do I want to wait further into the fall months? My advice to you is to please go ahead and list those now because your buyer pool is starting to taper off as we get deeper into the summer months. So go ahead and get those to the market as soon as you possibly can. Now, the odds of selling ended up popping back up from 58% to about 60.5%. I would have liked to have seen that number rise just a little bit more, but 60.5% odds of selling is where I take into account all of the available listings for sale versus those that go under contract and or close in the same month. And so again, it's about 60.5%. So we're now back to where it was, and it's actually lower than when it was pre-pandemic, where we were sitting at about 65 to 70% odds of selling. So this number is likely to continue continue to taper off through the end of the year. And so you want to get your listings to market as soon as you can, so you got the largest pool of potential buyers that you can get after. Looking at where we are in terms of balance, this number popped back down a little bit. We're now sitting at 17.6% of the inventory that we require to offset demand if we were to create a 6-month supply of inventory. We had about 5,500 units available for sale. We need to be closer to about that 30,000 mark, 31,000 mark. And I had a lot of questions this last week about this particular number. People are starting to use this a lot more in their listing presentations, talking about how we're still short on inventory despite going through a market shift, that we still only have about 17.6% of the inventory that we require to offset demand. We're not in danger of a bubble bursting. We're too flush with equity. We have an undersupply of homes. And plus, we haven't been hit with some sort of economic widespread hardship that causes a large loss of unemployment. And so we haven't seen those three factors come into play yet. So we're still not expecting there to be some sort of change or shift in our marketplace where we're expecting to see home prices really take a tumble outside of what we expect them to do seasonally. The rate of showings this week, showings increased by 40.8% week over week. So that was good to see an increase in the rate of showings. Showings really taper off over Independence Day weekend. We saw a nice little bump of activity. They went from 9,000 or about 10,000 up to about 14,000 total showings that were set this last week. So that means that if you put up a new listing, you should have had 2.6 shows per property on there. I'm still not able to get data out of Broker Bay. And so only about 10 to 15% of showings are set through Broker Bay. And so again, looking at those Broker Bay listings, you might add 1 or 2 extra showings in there, but the rate of showings has really tapered off from where we were back in January and February, where you were getting about 24 shows per week per property. Now we're looking at about 3 shows per week per property. And I've had a lot of questions asking me to help pull data based off of a certain area, what the showing activity looks like for those given areas. And so you can always reach out to me and I can pull a quick showing report for you to see how many showings you should expect for that next weekend. But about 2.6 shows per property. Looking at where we are for the number of shows to go under contract, it's 11.8 showings should yield you a contract, or about 12. So that means that homes, if they're only getting 2 to 3 showings per week, and it's taking 12 showings to go under contract, you could be on the market for 4 to 6 weeks before you go under contract. That's why I've suggested that you slow down the rate of price reductions. Back in January and February, if you weren't under contract in the first weekend, it was very obvious that you were not in your sweet spot in the marketplace, because we had nearly 90% of homes going under contract in that first weekend and 4 median days on market. It's taking longer to get people through your homes. And so you want to make sure that you get enough people through your house before you go through and make a price reduction. So I'm making the suggestion that you don't make a price reduction until week number 3 or even 4 at higher price points, to make sure that you get enough people through those houses at first. Median days on market is still holding at 11. I would have liked to have seen this number come down in this last week to see fewer days on market, but that's up 175% from where we were 1 year ago. But it's taking about 2 weeks for half of the homes to go under contract at this point. So again, we're starting to see more of those units going under contract in the second weekend rather than that first weekend where they're up on the market and avoiding those bidding wars. The rate of price reductions is our next slide. Looking at price reductions, it came down ever so slightly by about 2.3% this last week. But for homes that went under contract in this last week, it was about 34.6% of them made price reductions. Now, usually in the month of July, we end up seeing the rate of price reductions about 25%. So we're seeing more significant price reductions this year than what we've seen in years past, where people are tried to aggressively overprice their home using comps that were back in January and February, where they're not pulling off that 5 to 7% for off-peak pricing. And so you really have to pull back in your pricing strategy right now to get your homes under contract quickly. The rate of price reductions is about 5.5%. So in the past, what I would see is more widespread but smaller price reductions when we go through a market shift. This year, what I'm seeing are more significant price reductions where you have to get it down almost an additional pricing tier in order to get enough people through your homes. And so the rate of the price reduction this week was about $43,000 was your average price reduction for homes going under contract. For homes that are up to $500,000, we saw a nice little rebound in that market where some yellow cells started to pop back in here, where the market picked up directly following July 4th weekend. And so good for you for holding off on waiting and listing that property instead of doing it over Independence Day weekend, waiting until the week after. We saw month supply of inventory pop back down to 0.5 months worth of inventory, and we have about 1,000 daily active units in this particular market. Our active inventory remained relatively flat this last week since fewer new listings made their way to market, but we put up about 500 new listings in the market each week. Back on markets were about 107, and so that was an increase week over week by about 57.4%. And so following that holiday weekend, we saw more back on markets, but the rate of units that are going under contract and then falling apart is still only about 8 or 9%. And so we're not seeing a lot of those homes that are coming back on the market after they go under contract. But again, this market remains relatively fast. We're still likely to see multiple offers in this market with 0.5 months worth of inventory, but we haven't been above 5 months worth of inventory since we were back here over Christmas weekend. And before that, really during the pandemic, back here in 2020 was where we were sitting at about 0.5 months worth of inventory, which is up from the 0.1 months worth of inventory where we were when it was Super Bowl weekend, which was the fastest and furious weekend that we had all year long. The odds of selling is still sitting at 72.6%. It increased by about 2.2% this last week. It's down from 1 year ago only by about 1.7%. So this market hasn't been impacted due to downward pressure. As people are impacted by affordability, they're looking at lower priced homes at this point. Instead of buying that $750,000 house, they might be looking at that $500,000 house now. And so we're seeing more downward pressure from higher price points where people are looking at homes that are under $500,000 right now. Looking at where we are in terms of balance. In terms of balance, we're only got 9.1% of the inventory required to offset demand. That came down by 2.6% post July 4th weekend. Again, that number tends to bump up over July 4th weekend. We should have about 11,000 active units available for sale in this market, whereas we only have about 1,000 active units. So that market remains incredibly hot. Showings bumped up this week by about 33%. So we were looking at 4.5 shows per property per weekend in this particular market. And in this market, it's about 11 showings should yield you an offer. So again, you could be on the market for 3-4 weeks in this particular price range. So again, slow down the rate of price reductions for under $500,000. Week number 2 or 3 is probably the time where you want to make that price reduction. Median days on market jumped down from 9 median days on market over Independence Day weekend down to 7. So we haven't seen 7 median days on market since we were back here over in December of last year. So the market has cooled. But again, what the media is reporting is that average days on market is up 100%. Well, it's up from 4 to 7. So again, 7 median days on market is not a lot of time to spend on the market, especially for this under $500,000 price point. These homes are still getting snapped up pretty quickly. The rate of price reductions was up 3.2%, or I'm sorry, down 3.9% from where we were last week, but it's about 1 out of every 4 homes is making a price reduction in this particular price range right now. And the average price reduction is about 4.8% or about $20,000 off of the original asking price to get under contract. Next, we're looking at the $500,000 to $1 million segment. That represents about 60% of our overall inventory. We didn't see quite the same rebound in the $500,000 to $1 million segment, but some yellow cells did creep in there. So there was some rebounding that we saw going into this last weekend. Looking at our month supply of inventory, we popped down from 1.15 months worth of inventory to 1.2 months worth of inventory. So the market tightened up just a little bit this last week. Our average daily active count remained flat with fewer new listings going to market over Independence Day weekend. We put up about 1,000 new active units each week in this particular price range, and that went up by about 70% post-holiday weekend. Pending transactions increased week over week to that 19.6%. And so we're putting about 650 units under contract each week in this particular price range. So inventory is going to continue to stack up in this particular price segment. This is our most impacted by interest rates. We're seeing that these people are most loan dependent, with about 80% of them requiring financing to get into a home. The odds of selling popped up to 57.5%, which was up 1.9% over where we were over 4th of July weekend. I would have liked to have seen this number rebound a little bit more, but it didn't quite as much. And so again, the odds of selling is likely to continue to taper off as we get deeper into the summer months. Looking at where we are in terms of balance, we have about 20.7% of the inventory that we require to offset demand. We should have 17,000 available units for sale in this market, whereas we only have about 3,500. So we're far from a market in balance in this particular price segment. Number of showings per week, we got about 2.2 shows per property. That increased week over week by about 45.2%. So a lot of buyers returned to the market post-holiday weekend going into this next area. We're still looking at about 12 average showings to go under contract. So you could be on the market as long as 6 weeks in this particular price range. Median days on market increased again over this week, which was surprising to me. Normally this goes down after a holiday weekend. The rate of it was 14 median days on market. So about half the homes were under contract in 2 weeks or less. So again, you could be sitting on the market for about 2 weeks, 2 to 4 weeks before you go under contract in this $500 to $1 million price point. So again, lots longer on the market than what we were experiencing earlier this year. The rate of price reductions increased or decreased this week by about 1.7%, but it's about 40% of all the homes that went under contract in this price range last week made price reductions. Again, that number is typically about 25%. So we're seeing a lot more price reductions in this price range than what we had seen in years past. And the average price reduction was about 5.4% off of the original price, or about $40,000 off of the original asking price. In the $1 to $1.5 million segment, we're now looking at a slight rebound in this market as well. We had some more orange and red cells creep in, so this market got a lot more competitive as we were looking over post 4th of July weekend. We saw over 4th of July weekend that the month supply of inventory had popped up to 2.4 months worth of inventory. It's now back down to 1.4 months worth of inventory. So buyers really came back to this market after Independence Day weekend. We have about 520 available listings for sale on any given day in this market. We're putting up about 130 new listings each week in this particular price segment. Pending transactions rose week over week by 83.3%. So you did a good job if you didn't list over Independence Day weekend and you chose to list over the weekend directly following this last weekend instead. And so again, the market really rebounded nicely in this particular price point. We ended up seeing the odds of selling rebound nicely up to the 55.9%. We actually saw more resilience in the market post 4th of July weekend than we did in other price segments. So this market has actually warmed up quite a bit just in the last week. We're down to 15.1% of the inventory required to offset demand. We should have about 3,500 available units for sale, whereas we only have 519 for sale at this point. We're looking at about 2 shows per property per week. 2 to 3 showings per property per week is pretty common across all price points. And again, it's taking about 13 showings to go under contract. So you could be on the market as long as 6 weeks in this particular price point. Median days on market was still sitting at about 2 weeks for this particular price point. It came down by about half a day. And so again, looking at about 14 median days on market at this particular point for these homes that are between 1 to 1.5 million. The rate of price reductions increased this week, and so it was about 38.6% of all the homes that went under contract last week had a price reduction, and the size of the price reduction was 8.3%, or about $110,000 off their asking price. It's not uncommon to see 6-figure price reductions in this $1 to $1.5 million price point, because they've got to get it down an additional pricing tier in order to make an impact to get those properties under contract. Looking at the $1.5 to $2 million price point, again, there was a nice rebound that happened in this market as well, where we saw some more yellow and orange cells creep into this particular heat map. The month supply of inventory is still sitting at about 2 months worth of inventory, so it didn't come down like what we had expected, but it's hovering at about 2 months worth of inventory. So we're out of multiple offer territory in this particular price range. For every 1 buyer in this market, they have about 2 homes to choose from. We have about 200 available homes for sale on any given week. We're putting about 23 units under contract each week in this particular price range, and that actually fell after Independence Day weekend by 11.5%, which is uncommon. The odds of selling declined again this week by about 3.3%. So this market is softening even further as we get deeper into these summer months. Looking at where we are for percent of balance, we still only have 17% of the inventory required to offset demand. We should be closer to about 1,200 active units available for sale in this $1.5 to $2 million price point. And we're sitting at about 2 shows per property per week in this particular price range. And again, it's about 14 showings to go under contract. So you could be on the market as long as 7 weeks before you go under contract in this market. Median days on market popped up to 19 median days on market, so it continued to slow even further after Independence Day weekend, whereas Independence Day weekend it was about 13 median days on market. So about half the homes are under contract in 3 weeks or less. And so again, prepare your sellers to sit on the market for a little bit longer. Overall, that's still a short time frame for this particular price range. When I used to measure this or back in like 2010, that number was like a year and a half. So it's taking a lot less time to sell these homes. We had 34.8% of them reduce their price this last week. and about a 8.6% price reduction, or $170,000 off of their original asking price. And so again, the market slowed for higher end price points, even more so over after 4th of July weekend. So I can't stress to you enough, get your listings to market as soon as you can, pull back in your pricing strategy, because a lot of people have been priced out of the market, and get your homes as show ready as possible when you're getting ready to put up these new listings. Looks like we had some questions that popped up.
You do. Do you want me to just, I'll jump in here and talk about, one of the ones was the price reductions. Last week you had mentioned 33. Today you had mentioned 25. What's the difference between those?
I'm sorry, what was that?
Last week you mentioned 33% of homes needed price reductions was average.
Yeah.
This week you just said 25.
So it's 25% typically
Okay.
make price reductions in July.
In July.
So in July. And so that's based off of data from 2013 through 2021.
Okay.
And so we've been in a similar market, except for these last 2 years. These last 2 years have been the hottest 2 years out of that last 9-year cycle. And so again, it's about 25% make price reductions, and it was about 33% of them were making price reductions this week.
Okay. And is this Dennis? Who is this? It's cut off for me, but he brings up an excellent point. I guess other than price reductions, are there other ways? He's like, I'm able to set my watch, which is something you say a lot. I'm able to set my watch by to the June and July market slowing down over the past 8 years. How much different is this July to past Julys, maybe excluding?
So it's down even more this July. We've been on a downward trend since post-Easter, where fewer homes are going under contract. The odds of selling has decreased, and longer days on market since post-Easter weekend. So our cooling trend set in earlier this year. And so we were post-July 4th, closer to Easter weekend than we were actually July 4th. So I expect now that we're post-July 4th, we're going to continue to see a deeper cooling trend than what we had seen in years past.
The 3 things for the bubble to have happen.
We need to have an oversupply of homes, so more than a 6-month supply of inventory. We need to have a lack of equity in the market where people are upside down on their houses. And then we need to have that coupled with some sort of economic widespread hardship that causes unemployment to go up. And so we don't have any of those conditions that exist right now. So we're not in a bubble. We're not likely to see home prices correct in any substantial way outside of the normal seasonal cooling trend that we typically see July, August, and September anyways.
Yeah. You know, and even in that, I mean, I'm going to show you some employment information that starts to show us that we're heading towards slightly less employment or more unemployment, however you want to split that one. But I still think there are the same people that were impacted by the pandemic, that it's the lower income Americans who are probably going to be hit the worst, which breaks my heart. They're not necessarily the homeowners. We still have a lot of job openings, 11.3 million. But even with the unemployment, Megan, to your point, we could see that go up, but how much will it impact housing, considering we have a ton of equity and we still don't have enough inventory? So it's like, get all 3 of those things. Nina asked a great question, and it's a long question. I don't want to read the whole thing, but it does speak to the fact of if somebody just bought or was planning on this scenario that she put in the questions and answers has to do with a new build, right? So the new build was planning on listing at a certain price, and of course, delays in construction. So here we are in this market, and they're not able to price it at the point that they wanted or planned for, probably budgeted for. And so now they're thinking that they're losing money. It's the same conversation that if you just bought, say 3 months ago, are you now losing if that home next door is listing for 5-7% less than what you paid for it? So how do you have that conversation? I've been having that conversation a lot as well. How are you having that conversation with people?
So going back and talking about the data points and showing people the rate of price reductions that are happening right now. We have roughly 4 times the amount of inventory in our market now than we did back in January and February. And that shifts the relationship between supply and demand. When there's that shift between the relationship of supply and demand, price reductions start to come about because buyers have a better advantage at having negotiating power right now. Median days on market is up. And so again, it's a shift in the market that's happened along with affordability. affordability. And so we have to go softer in our pricing strategy to ensure that you have the largest pool of potential buyers to expand your property to in the marketplace. It's not like it was back in January and February, where we had this complete lack of inventory in our market, where we only had 5 to 6% of the inventory that we required to offset demand. This shift in inventory really is changing the environment in which and how you have to list and price your properties right now.
And it is a long-term venture, right? So somebody that was flipping homes might have been caught up in this, and regretfully, they might not be able to get, and the new build situation is also very valid. But long-term, you're not expecting to have bought 6 months ago and sell it for most homeowners. So long-term, we know that the values always go up, but there are dips and corrections. We were on fire way more than we ever could have sustained for the last 2 years. To pull that back slightly, if you still, when you're having a conversation, especially with a listing conversation, if they have to pull back, the new build is a different situation because he's rolling in costs and he had budgets. But if you're talking to somebody who's owned their home for the last 5 years, and now they're saying, well, now I'm losing money because the guy next door to me sold for less than what the person on the other side of me sold for 6 months ago, take that listing and show them the value that they've increased over the last 2 years. What was that home? What would it have sold for last year or the year before or the year before that? The gain is huge. Maybe it's not as much at the top, but it's still a significant gain that that seller is realizing by selling now, even after missing what might be considered the peak.
Right. There was one other question that was in there. And so assuming a 6-month supply of inventory is a balanced market, which I assume is a long-term average, thoughts on what more current balance is today, given demand is likely lower on an average given current macro environment. And so we use a 6-month supply of inventory because that's the rate at which inflation matches the rate of appreciation historically. That's different than what we have on average in Metro Denver. On average in Metro Denver, we average about 3.5 to 4 months worth of inventory. So we've always trended more deeply towards a seller's market in Metro Denver than we have a buyer's market in Metro Denver. Our market has consistently been better than the average across the United States, but a 6-month supply of inventory is not the same as an average or a normal market in Metro Denver. An average or a more normal market in Denver is going to have 3.5 to 4 months worth of inventory.
And it's interesting, that question. It's like, well, how do you justify because demand has come down? Well, the supply and demand equation, that 6 months, yes, inventory, it feels like it's coming online, but we're seeing more inventory because we're seeing the less demand. We still have barely over 1 month of inventory. So that is in there. Buyers are just getting a few more days to look at homes. So it's kind of already baked into the model.
Mm-hmm.
All righty. Oh, I just started the presentation and then I closed it. That's awesome. All right. All right. Oh, I see what it did. I apologize. Give me a second. It started on the wrong screen, which is absolutely okay. So I'm going to share my screen first since I can't seem to do this. Presentation. The two of us, what's up with the presentation issues today? I don't know.
I know mine didn't look very nice today.
No, I know. I'm kind of like, it's fine. All right. So the slideshow from current slide. What is it that you always press? Why don't I know this?
I do you have slideshow next to animations. It's the next highlighted one. Slideshow from current slide.
Okay. All right. So here we go. So my apologies for
you've got the double screen up.
Oh, it's got the double screen? Oh, you got the wrong screen. That's what I'm having. So you know what? It's both of us. It's totally fine. Mm-hmm. So I'm just going to share the screen that you've got because it doesn't matter. So, here we go. The two of us are together on this. But I wanted to kind of go through what is the economic updates that we need to be talking to our clients about in this market, right? Because there's a lot going on. So going into another recession, a quote by Jamie Dimon with JP Morgan Chase, he had said just this morning, he was having a shareholder meeting, and he talked about the fact that going into another recession, the consumer is strong. They're less leveraged, but they're still in better shape than they were in 2008 and even 2020. And the jobs are plentiful. Remember, we still have 11.3 million jobs opening. Yes, we will lose some jobs. Unemployment is starting to tell us and give us some hints of that. But right now, we're steady going in. We still have over $2 trillion additional money in savings. We have a strong consumer, right? So that is where we're the starting point. Will people lose some money? Yes. Will people lose jobs? Yes. Will there be hardship? Yes. When we go into a recession, that's part of the definition. But our starting point is stronger than it was in 2008 and 2020. Unemployment still stayed at 3.6. I talked about this on the Saturday email, but it came out on Friday, so right after our last market update. So unemployment stayed at 3.6. Why is that? We actually had conflicting information. So there was 372 more jobs on the BLS report, but the home calling, where the home household survey, I need more coffee. That household survey who actually calls 60,000 homes, they were down by 315, but we actually saw that the labor force decreased. So that is why the unemployment stayed at 3.6. If we look at the household number, which usually impacts the unemployment number, it should have started to tick up since more people were off work, but it didn't because of that labor force decreasing. So this is a little bit of, it's kind of like the CPI and the PCE last month, where they kind of said different information, conflicting information, that's giving a little bit of confusion to the market, which is a lot why we're seeing the 10-year treasury move around so much. And I think we continue to see that going forward. We're going to see the volatility within a range. We're actually seeing that and saw that a lot yesterday when the CPI numbers came out. We saw it moving within a range, hitting up against the top and bouncing back down again. I think this is also going to control the interest rates. So jobless claims came out this morning. It comes out every Thursday morning, and it actually was up 9,000. So that number seems huge because they're like, it's the biggest number in 8 months. Yes, it is, but it's been really low for the last 8 months, but it is slowly ticking up. And we have to recognize that when unemployment starts to tick up, that really is the beginning of the recession. So this is kind of like the hints. Okay, we're coming up on the recession. Some people will say that we're already in a recession, that we were in a recession the first quarter. I'm still going to debate that because we had consumer spending was still up and unemployment was still down. Now we're starting to see those things move where we're headed into a recession. And why this is so important is because the headlines and the conversations daily are people are sitting on the sidelines waiting for the bubble to burst. What happens to housing during a recession? Where can I expect the value of my home to go or interest rates to go? I'd rather sit this one out, right? When realistically, you need to be having the conversations of taking action because the opportunities present inside these times. So let's just keep going through this. So the consumer price index came out also this week, and at 9.1, holy smack, that's big. It was a big number. Yet the core was actually quite a bit less when you strip out food and energy, but this was above the forecast of 8.8. So we're seeing a massive amount of inflation. Remember, though, this is looking backwards. This number was taken in the middle of last month, in the middle of June. There's been plenty of news because the news is like literally daily, definitely weekly. I certainly have enough to talk to you about every Thursday, where things have happened since the middle of June, since this number was calculated or the data was collected. The number was just calculated and obviously released this week. The big portion of this, rents and the ownership equivalent of rent. So let's talk about this owner's equivalent of rent and rents. Those are 40% of the CPI core. So the core CPI, removing the food and energy, 40% of that number is rents and owner's equivalents of rents. What is owner's equivalent of rent? Well, when they're doing these surveys, trying to figure out what's inflation, how do you sum up what a homeowner's costs are? Do you start asking what they pay for all of utilities, what their mortgage is? So they throw a dart and they say, okay, we're going to pick a number. We're going to be consistent. Obviously, it's the same number that they talk about every single time, but they survey owners and say, if you were going to rent your home, what would it be? Like, how much would you charge if you're going to rent your home? I don't know. I love my home. I would rent it for a lot. Like, right? Like, how do you decide that, especially if you're a homeowner and you haven't been even thinking about renting your home? So this is up. It is up significantly, but it is an estimation because if I really look at what rents are doing, they're even higher than this. So should the CPI be even higher than 9.1? Well, interesting as this continues, this is the battle, is this going to continue to put pressure on inflation in an upward momentum? I'm going to show you in a minute, there's some factors that are saying that this is the top of inflation, that it's not going to get any hotter, that it is going to come back down from here. Really, no one knows. That's the thing. You talk to these economists and these experts, and we're all kind of trying to guess what's the next step. But we can talk about the big things. We can talk about this is how this metric or this report or this day's events is impacting interest rates. It's impacting your daily budget. That's impacting your ability to afford that home that you're wanting to put an offer in. There's nothing worse than finding that perfect home over the weekend based on a quote that was given to you on Friday and it's different on Monday. So what's going on into the weekend? Which is why not only do Megan and I do this report every Thursday for you to help you into the weekend, but then I also uplift it with a Saturday blog talking about if anything came out on Friday that you need to know and what were the rates at the end of day Friday that you should be looking at in case you want to lock over that weekend, which isn't a terrible idea. And you can do that. It's aftermarket, but you can do that depending on where we think the interest rates are going to go that following week. The producer price index, the PPI, also came out this week. My goodness. So we had all kinds of things. Look at that. It just was record high. So it came out at 11.3. This was up 1.1% month over month. But if I strip out food and energy, it's down. It's only 6.4%. So what is that saying, right? I mean, a lot of this number is that food and energy. And we know obviously, gas right now is coming down. There's a lot of people are saying that's going to bounce right back up again. But stripping that out, we are starting to see a little bit of a slowdown in prices. But where is this going? So the PPI, remember, is wholesale. So this is before it gets the consumer. You're looking at the PPI, you're looking at the cash rate index, which is trucking. And then you look at the CPI, which is the retail, which is what you and I are paying for things. In the middle, we're looking at small business confidence. And what they're pricing things at and what the cost of their goods are. Right now, small businesses are struggling because the price of everything is high and they're trying to attract consumers. So the small business confidence index, albeit is not very strong, talking to some of the banks and the credit card companies and the lending, they're feeling like they still have the business coming in. Americans are still spending. They're spending less. They're discerning. Is it worth it to me? I don't know. Amazon Prime was the last 2 days. I didn't partake at all. I don't trust myself. I avoided the website, but there were a ton of sales because Amazon, Target, Walmart are all trying to move product right now. So we're going to see when you have all these sales, that means that we're going to start seeing that inflation index come down. It's a record of what are you paying for things. Shipping, the cash rate index. We talked about this a lot back in 2019, at the end of 2019, coming into 2020, we were headed towards a recession. The cash rate index was actually the clue that was telling us that we were heading into the recession. Well, that has dipped back down, which is where it slows down, which is where we're starting to see recessionary. But it's kind of all over the map right now. So it gave back what it had gained last month, but it is down 4.1. So I saw a headline that freight and shipping is slowing down. We're heading to a recession. Well, yes and no, right? I mean, I'm not going to take 1 month and say this is it, that the recession is coming, but being aware of the direction and then the trends of each one of these reports is starting to give us more of that, hair on the back of your neck. It's like, what is happening to the economy? How do I continue to communicate with my buyers and sellers? How do I communicate in a way that helps them take action? Right? Even if action isn't buying, I'm okay with that. But taking action, whether it's getting off of your pipeline or actually closing on a home, what is the best financial future? Sitting and spinning is what I'm seeing a lot right now. I'm having a hard time making a decision. I get that. There's a lot of information coming at us right now, but that's where understanding where this is headed. So commodity prices, a lot of headlines right now on commodities coming down. What will that do? I actually put these two charts together. What is the monthly index as well as what is the percentage off of record prices to see kind of natural gas and lumber and cotton and wheat. I mean, lumber, absolutely direct impact on housing. A lot of this is going to have impact on housing, not as much the soybeans and the corn, but yes, the copper, the gasoline, the trucking across the country. So seeing this come off the peak. So it's not tiny, like it didn't drop. It's not it's like this small little drop. Commodity prices are falling. So just continuing to watch the trend lines. Will this continue? Will we see it drop several months in a row? Will that give rest to this incredible inflation numbers that we've been seeing? Or will this just continue to drop just slightly enough that we don't see maybe the benefit, and the increase in housing, which is still catching up, continues to lift inflation? Jumping into the numbers a little bit deeper. China might, oh my God, if China locks down again, I don't even know what I'm going to do. So another subvariant of the coronavirus now has popped its head up again. We're hearing that they're seeing it in California. Now China's talking about whether or not they lock down again. Let these poor people live is what I just keep thinking. But it's also going to impact, if this happens, we are going to see inflation tick up again due to the inability to get those shipping containers off the ports. So just continue to watch this. If they shut down again, if it tends to be relatively controlled quickly, then it won't turn into anything. But that just happened. Okay, so we also have the Fed watch. So all of this is impacting what is the Fed going to do. So there's actually, I grabbed this morning, we've got 13 days and 2 hours and 32 minutes. It's like my wedding or a birthday or a big event. No, it's the Fed watch. Because people are talking about the fact that as the Fed starts pushing up these numbers, it's going to impact your mortgage rates. But is it? We're going to talk about that in a second. The probability, there's also, as part of this Fed Watch tool, and I'm giving you the website in case you're as geeky as I am, but there's in here also is, what is the probability? What is the market saying the probability is for the increase amount? Now, remember, Fed rate, for whatever reason, is within a span of 0.25. So it's 1.5 to 1.75 right now. So they're saying we've got a 19.7, 20% probability that it's going to go up to 225, 250, and an 81% probability, or an 80% probability it's going to go up to 250 to 275. That means that we're expecting in July, most people are expecting, 80% are expecting it to go up 1 full percentage point later this month. So, and then what is it going to do in September? Remember, originally, a couple months ago, we were talking about where the Fed might pull off the gas and allow the quantitative tightening to start to take over, right? So as that was happening, we were thinking that this Fed rate would start to back down, but that's not the case. So right now, we're actually thinking that we're going to see 1% in July, 0.75 in September. Mountains of things can happen between now and then, but this is something that we're watching, and it will impact things because it's impacting your consumers. You have to know they're reading headlines like this one that literally came out today saying the latest mortgage news, rates resume their march towards 6%. Further down, it talks about the fact that the Fed is going to be increasing the Fed rate 1%, and watch out, walk in right now because the rates are going to go up. But the rates didn't go up with the news of the CPI and the impact that that had with the problem, because that all happened in a day. I'm sorry, I have to go back to this. So this was actually where it is now, where it was a day ago, where it was a week ago, and where it was a month ago. So based on the CPI information, the probability numbers jumped up, right? So the probability numbers jumped up literally in one day. So they're saying, okay, this is happening. The interest rates are going to go back up to 6%. Yet we actually dropped. Our interest rates got better. Why? So this is really interesting what's happening right now, because we're falling into an assumption that we're going to see a recession next year and that the Fed is going to pull back on the Fed rate. They're going to do what they need to do. They're going to push the Fed rate up as high as they need to push it up to slow down inflation, to then be able to drop it again, to spur demand back up. So the long term is actually feeling like, okay, we're headed towards recession. We're headed towards lower interest rates. I don't need to go up. I've already kind of baked in the fear factor. But what we're seeing is the short term is taking it in the shorts. So the long term, our 10-year treasury hasn't really, it crossed over 3%, back down, crossed over, came back down. It's really having a hard time getting above 3%. But the 2-year jumped up to 3.24. So the spread there is 0.25%. That's about as big as it's ever been. So if we show that treasury yield, yet another indicator that a recession is around the corner, not that it started in the first quarter, but that it's coming, that I'm just going to find all the information that backs my theory up. No, I'm just kidding. This is like the information that it is. This is the recession indicator, this 2 and 10 year. Now we had this right before we had the COVID, because we were headed into a recession before the pandemic started. We had it again back in April, and here it is, the 2 and 10 year have inverted. The Atlanta Fed is ongoing, so they're constantly adjusting where they believe the second quarter GDP is going to come out. We're going to find out where the real number is here very quickly, but they actually popped it up. So I had talked about the fact that it had dropped down to negative 2.1 based on some information. Now, based on some of the latest information, but not the CPI, they're going to be adjusting this again, either on Friday or Monday, but not the CPI. So before that, some of the other transportation information, the production information, they're thinking, okay, consumers are still spending, right? And maybe commodity prices are coming down. And so maybe the GDP is going to be negative, but it's not going to be so bad. So we're continuing to watch this, because obviously the 2 consecutive quarters of GDP decline define a recession. I know that, right? We all know that. Mortgage purchase applications were down again. Here's an interesting bit. So they were down 3.6%, but refinances were actually up 2%, because that same rate chart that I just showed you, if you go back a week, we had a nice little dip. Because remember, the PCE came out, which actually helped the markets. We saw a dip in rates, and people who needed to do a refinance, we're talking about doing a refinance, that were doing cash outs, maybe to buy other investment properties, took advantage of that. So we saw the refinance applications up 2%. Mortgage purchase applications are still hovering. We know that June is low. But yet home ownership equity. So going back to what Megan was saying, the 3 indicators, we're talking about unemployment, and we're going to start seeing it tick up. And when it ticks up, that is the starting gun of the race. That is this transition. I would often think of it as a relay race, right? It doesn't end. It's just a relay. We're going to hand off from expansion back to recession, and from recession back to expansion. It's part of the economic cycle. It is not a bad thing, especially when we can show historically housing always does well during recessions. So we have this incredibly high home ownership equity. Make sure we got a couple minutes left, 4 minutes. Double what it was in 2006. Even if some people lose some of that, as we talked about earlier, taking those homeowners and going back to what they would have sold their home for 2 years ago, 3 years ago, 4 years ago, putting that realistic, or that showing them the comparison. Yes, I know the neighbor next to you sold for a lot more, but let's see where we really should have been and price it so that we can get multiple bids and maybe even get right back up to the number that you want. We have incredible homeownership equity. Also, the average LTV is 42%. We have 38% of homes are owned free and clear. And of those who are mortgaged, 75% have a mortgage rate of 4% or less. All of these things are supporting our homeowners. Vacancy rate is near zil. So we've got a home vacancy rate of 0.9, rental vacancy rate of just under 6. Why does that matter? Because if I'm living it, I'm going to fight for it. I'm not going to lose a roof over my head just so I can go rent somewhere else when I know rents are going up. Very important to know this. I am not reading all of this, but it will be in the presentation slide deck, which we'll put up on our Agent Ignite Facebook group. Redfin did, and you guys see all the local data that Megan shares with you. Redfin just did a comparison, the 4 weeks rolling up to July 4th, talking about where we were year over year. And shockingly, we're just super close nationwide. So we're talking about the strength of the housing market. Yes, we're talking about the Denver market, but you have to also keep your eye on the national market, because that's where bubbles are bursted. Right? They're not bursted locally. Some neighborhoods will see a little bit of a price reduction, but we're not going to see a massive swell of inventory due to price reductions and foreclosures. It's just not going to happen. We have a very small foreclosure rate, both here locally and nationally. But when you see these numbers, and you can read them later, and you can get the PowerPoint presentation, but when you see the comparisons barely off of where we were last year, could you imagine what would it look like if we didn't see interest rates go above 6? How crazy of the market would we have been in right now if we didn't have the Fed raising the Fed rate and mortgage rates going above 6? I don't know that we could have continued to sustain the market we had. We shouldn't be complaining about this market. We should be celebrating this market. I have more down payment assistance loans in my pipeline than I had for 2 years. I love first-time home buyers, and I love the opportunity. We're also doing a ton of renovation loans. Those homes that Megan mentioned with the green carpet and the outdated, I can't help the fact that it's on a busy street or 2 doors down from Safeway. but I can help the fact that it's got green carpet, it needs an extra bedroom, and it desperately needs a redo of the kitchen. Renovation loans are picking up because those homes are sitting on the market 3, 4, 5 weekends. Also, quick closings. We celebrated this on social. Matt on our team just got a clear to close on 100% loan to value physician loan. You need to think outside the box. You need the non-QM loans. You need the bank statement loans. You need to get your buyers under contract where another lender told them no. My team is diligent in finding solutions that other lenders don't. And I've run out of time, but I just want to make sure that you guys, I'm constantly thinking on the Agent Ignite Facebook group, I did a brain dump. I had a conversation with a listing agent. She was like, what else besides a 2-1 buy down do you have? I did a brain dump of everything I could think of. There are opportunities to get more eyes on your listings. And do not forget to register for next week's Agent Ignite. Megan and I are in person. It is at Columbine and it is going to be amazing. And the room is full. So cannot wait to see you there next week. Megan?
You got a couple of questions that we need to circle up before we turn off. How do you recommend offering incentives or buy down? Just say offer X points at X price. I was thinking about a price reduction, but stating in broker private remarks comments, a higher price offering points.
You can absolutely, I can do a quick 1.5 to 2 minutes. I know I talk for a long time most of the time, but I can do a quick 2-minute video that actually shows the benefit of the 2-1 buy down. And you can put that link in your broker remarks. Or you could simply say that the seller is willing to do a 2-1 buy down, which will save the consumer, thousands of dollars. I can even give you a number for what that is because it's based on the loan amount, the estimated loan amount for your purchase price. Now, remember, it's not for jumbos. This is for conventional and govy loans.
And then Lauren wants to know, are you still doing the lease buyout program?
Yes. I love getting first-time home buyers into homes. Yes, yes, yes.
Had a couple of comments and then that's it. So we're ready to sign off.
Yes, you guys are awesome. You're going to have this incredible weekend. Megan, myself, we want to make sure that we're supporting you and your clients. We would both love to see you at the closing table. Yes, we are here to answer your questions and support you and educate, but also to then turn around and support and educate your clients. So please do not hesitate to reach out to either one of us anytime you need anything.
Awesome. The reason why we put these together is because we want to win your business over. While Nicole works for Fairway Mortgage, she independently wants to get your business, as do I at First American Title. So I hope that you'll refer both of us specifically on your next transaction. So please don't hesitate to reach out to us with questions. We'll get copies of the slide decks out to everyone that attended here shortly. And so give us about an hour and a half, and we'll get you guys out a summary. Other than that, we hope you guys have a great weekend. And thanks again for tuning in. We'll see you guys next week.
Bye, guys.